encourage certain societal behaviors. So for example, the mortgage interest credit, we have decided as a society that home ownership is a good thing for us overall. It creates more stability in communities, and so in order to encourage that, they have this mortgage interest deduction. Now, at least that was the philosophy behind it when it was developed. Now, we've gotten to the point with our tax law, of course, that hardly anybody itemizes their deductions, so nobody really even gets the benefit of that, right? So it's, whether or not it still has any utility is questionable, that particular tax benefit. But a lot of these as well. So socially, we've decided that it's valuable to have more individuals working. And so we provide this credit so that all members of a family it helps all members of the family to work. Now again, it's not a huge amount of money. It can be, relatively speaking, it can be, but for a lot of people it's not the difference between whether or not you're gonna work or not. But we've just decided as a society that we're going to provide some sort of offset to those expenses. A lot of these credits are doing just that, the education credits as well. We want to encourage people to receive an education. So we do that by providing some education credits. So this first one here, the credit for child and dependent care expenses. So this is mainly for like daycare type of expenses, but it does say child and dependent care expenses. So it might not just be a child. An individual who is your dependent who requires care, and that could be an adult individual if they qualify, could qualify for this if they meet certain qualifications. But for the most part, this is just for children. Now, first off, we have to determine what are qualifying expenses. So what can we include in our credit calculation. So necessary expenses, including those paid for household services and expenses for the care of qualified individuals, so that the taxpayer can be gainfully employed, are eligible. If you are a stay-at-home parent and you get a babysitter to take care of your child once a week, you're not employed, not earning income, and you're not doing that in order to provide the time for you to be employed, that would not be considered a qualified expense. So you do have to be gainfully employed. Now you'll see when we go down further, there is an exception to that for individuals who are full-time students as well. Expenses would include any expenses incurred in the home or outside of the home for a babysitter, housekeeper, cook, or nanny. So housekeeper or cook. Now, again, it has to be for a qualifying individual, and it has to be so that the taxpayer can be gainfully employed. Expenses paid to a family member, such as a grandparent, are eligible as long as a relative is not a child of the taxpayer under the age of 19 and cannot be claimed as a dependent by the taxpayer. So you can't say, oh, husband, take care of my child and I'll pay you for it, and then get a deduction for that, right? But you can have your children, pay your children to do it. Now the other side of that is they have to claim any amounts received as income on their end in order for you to get that deduction. If the expenses are incurred outside the home at a dependent care facility that provides care for a fee for 6 or more individuals, the expenses will qualify only if the facility complies with all applicable state and local laws regarding licensing. So technically speaking, they have to, if it's a care center, then they have to be licensed by the state in order for the credit to qualify. Also, out-of-home expenses incurred while caring for an older dependent or spouse who is incapacitated would qualify as well. So if you need, your spouse has been injured or something and is unable to care for themselves, or you've got a grandparent who is your dependent and they've got Alzheimer's or some sort of disease where they're not able to care for themselves, and you have to hire somebody to come in and provide, and this is separate from medical care, but provide assistance to them or just to be there so that they don't wander off or hurt themselves, then that would qualify, as long as they have to live in the household of the taxpayer for at least 8 hours a day, incapacitated dependent who would otherwise be institutionalized. So the only other option is to institutionalize them. So who is a qualifying individual? A person under the age of 13 who is a dependent of the taxpayer, or a dependent of the spouse or taxpayer who is incapable of caring for themselves and who lived with the taxpayer for at least half of the year. So if it's for child care, the child has to be under the age of 13 on December 31st. If they turn 13 on December 31st, then any care received after that point does not qualify, okay? So a child under 13 meeting a special dependency test of divorced parents would be deemed to be a qualifying individual for the custodial parent, even if that parent cannot claim the child as a dependent. So in this case, if it's divorced parents, that child is considered qualifying for the parent that has custody of them, okay? Married taxpayers have to file a joint return. So this is one of those areas where married filing separately is detrimental, because you can't claim this child and dependent care credit if you're married filing separately. Married taxpayers filing a separate return only under these circumstances. So if they lived apart from their spouse, they have to meet all of these conditions. Lived apart from their spouse, furnished more than half of the cost of maintaining a household that the qualified individual lived in for more than half the year, have a spouse who is not a member of the household for at least the last 6 months of the year. So if that is the case, then they can go ahead and claim that credit. All right, so how do we calculate this credit? So we know only certain expenses are going to qualify, and only certain individuals qualify as dependents for purposes of this credit. So it is calculated as a percentage of employment-related expenses paid during the year. So that percentage ranges from 20% to 35%, and it depends on AGI. The lower the AGI, the higher the percentage. So for example, if we have, and this isn't, we'll see the chart here in a minute, so this is just an example. If you have $2,000 of expenses, and because of your income, you're allowed a credit up to, what do we say, 30%, then that means that your credit is going to be $600. So you're not getting a credit dollar for dollar for each of the expenses that you incur. In order to calculate the credit, it's going to be based on a percentage of your expenses. Okay? But the credit will reduce your taxes dollar for dollar once it is calculated. You'll see in a second what when we look at the chart, it's a little bit easier to conceptualize. Maximum amount of qualifying expenses for any year is limited to $3,000 for one qualifying individual, $6,000 for 2 or more. So if you have 9 kids that you got in daycare, your maximum is still $6,000. Try finding daycare for one child for $6,000. It's very difficult to do. But that is the maximum. So if we have one child and we paid $4,000 in expenses, the maximum amount that we get to use in order to calculate the credit is $3,000. Okay? If we had 2 children, then we could use the whole $4,000 because the maximum is $6,000. Does that make sense? Okay. So we're always going to be limited to the $3,000 or $6,000. No matter how much, so it's going to be that amount or the amount you actually paid, whichever is less. Yeah.
That limit
Yep. And the most that you can apply that percentage to, once you figure out what the percentage is 3,000 for one child or 6,000 for more than one child. Okay. All right. Now, it is also limited to the amount of earned income of the taxpayer. Again, earned income is income that has been subject to Social Security and Medicare tax. Wages, self-employment income, that's pretty much it. Partnership income, if you're a partner in a partnership, that would be considered to be earned income. So, wages, salaries, tips, other taxable employee compensation, net earnings from self-employment. Only taxable compensation would be included in this calculation. So earned income does not include non-compensation income, such as interest and dividends, unemployment compensation, or child support payments. If a taxpayer receives dependent care assistance from an employer, that also has to be, reduces the gross income in that calculation, because you got that benefit from it. The expense limit is reduced by the amount excluded from income. We'll go through some examples here that show this. Now, as I mentioned, you have to work. However, if you are a full-time student, you are deemed to be working. You can get the amount of income that they deem for full-time students is $250 a month for the months that you are in school, up to $500 a month for 2 or more children. So, for example, so that's $3,000 and $6,000 per year, essentially. So if you have one child, as long as you're in school those months. So if you have one child and you're in school for 9 months, full-time student, your deemed income is going to be $250 times 9, which is, what is that? 2,500 minus 250, so 2750. No, you're right, 2250. Sorry. That's your deemed income. So, the maximum amount that you can use in calculation of the credit would be this $2,250, even if you paid $3,000, $4,000, $5,000.
Why though? Why?
Because the whole idea behind it is to provide you with the time to work or work on your education. It's not just, you don't get a credit just for babysitting, essentially, or for daycare. You have to actually be using that time toward, the idea is you're using that time toward the generation of taxable income, right? So the federal government is going to make money off of you because you're going to be working, and that income that you're earning while you're working is taxable, but they're giving you a little bit back. Yeah.
So if you're a full-time student and working, is that added to it?
So yes.
Okay.
Yes, so your income, then in that case, you wouldn't have to use the 250. Well, you wouldn't have to use the 250, but like if you worked, so 9 months, and then like you say you worked in the summer, yeah, then that would be added to this $2,250 if you had that daycare during that time. Yeah.
So is that only if you have daycare then?
Or if you have a nanny, you hire somebody. Now the thing about that is you have to, when on this form, you'll see that you've got to put down the social security number or employer identification number of the person providing care. So that means that person is going to have to claim it as income on their end.
So if they weren't claiming it, then you couldn't put it on yours?
If they don't give you, well, you can still put it on yours as long as they give you their social security number. But they have to give you your social security number. Yeah. And I know that there are a lot of, kind of under the table situations where people will provide daycare and they don't want to provide their social security number because they know that then that'll be tracked, it'll be matched up, that they earned this income. But yeah. So $250 a month, or for 2 children, it would be $500. So 500 times 9, so that's 4,500. And again, the other limit would be 6,000. So it's always gonna be the lesser of those amounts. So here we've got Bill and Susie. They paid $6,400 in qualified employment-related expenses for their 3 children. So our first limit here is 6,000, right? We can't go over 6,000 for those 3 kids. Susie received $2,500 of dependent care assistance that her employer properly excluded from her gross income. So she's already had that tax sheltered, right? It's not been taxed. The amount of employer-related expenses that Bill and Susie can use to determine their credit is $3,500. So the first thing they've got to do, 6,000 is going to be the max. Then they've got to reduce it by the $2,500 that they've already received a benefit from, right? So 2,500 minus 6,000 is 3,500. Note that the taxpayer must apply the dependent care assistance against the $6,000 limitation, not against the total, okay? Unless this was less than $6,400. So if it was $5,900 that they paid, then the maximum would be $5,900, and we'd have to subtract that $2,500 from the $5,900. That make sense? Okay. All right. We got Sophia and Elijah. They paid $3,800 in qualified employment-related expenses for their dependent daughter, 1 child. All right, so now we're limited to 3,000. That's our first limitation. Their AGI was 42,000. This included 40,500 from Sophia's job and $1,500 of self-employment income from Elijah's business. So, I mean, he may have made $100,000, but after all of his expenses and everything, he's down to $1,500 of self-employment income. The limit is $1,500, not Sophia's amount. It's gonna be whoever made the least amount of money, whatever the lowest is. So that's gonna be, and then we're gonna base the credit on that number, okay? Ethan and Riley paid $4,200 in qualified employment-related expenses for their dependent son. 1 kid, so we're limited to 3,000 right now. Ethan's AGI was 42,000. Riley was a full-time student for 9 months of the year. Ethan and Riley's qualified employment-related expenses are limited to $2,250. Those 9 months that we calculate here of deemed income. Even though Ethan's AGI, Ethan's income was 42,000. They're gonna use the individual with the lowest AGI, the lowest income, in determining that limit, okay? All right, so the percentage, any questions so far? Sorry. All right. So the percentage used to determine the credit ranges from 20 to 35%, and it depends on the taxpayer's AGI. I don't know what that was. 35% for taxpayers with AGI of 15,000 or less, and it's reduced by 1% for each additional $2,000 of AGI. Minimum percentage is 20%. So this is the chart that can be used. So let's just say we've got, let's make something up here. So we've got 26,000 AGI, 2 children, 7,200 of expenses. That's a lot for 26,000. I hope they got some other money somewhere. So, yeah, okay. So we've got the AGI. It's over. We've got income, right? And we'll say that this is for 1 person, okay? If this person is head of household. Okay, one individual, 26,000, 2 kids. So $72,000, I'm sorry, $7,200 of expenses, but our max is gonna be 6,000 that we can base the credit on. Okay? 2 kids, so we'll take that 6,000, find our income range, which is between 25 and 27. Is that 29? 29%. 6,000 times 29%, which is, I don't know, what is that?
1740.
Our credit is 1740. In that case. Okay. Let's say we had, married filing jointly. And so taxpayer 1, taxpayer 2 was a full-time student for 7 months. Same expenses. But now, our $6,000 would be the max, but now we've gotta limit it to only 7 months at 500.
Is it 500 because of married filing jointly?
It's 500 because there's 2 children.
Oh.
So 3,500 is the max now. That's what we're gonna multiply 3,500 times 29%. Which is whatever that is. Okay?
1050. 1,050.
1015?
So you don't include the first taxpayer then?
You do,
For the
but
max.
we're gonna take whoever has the least amount of income, earned income. This taxpayer has $26,000 of earned income. This taxpayer has 3,500 of deemed earned income because they are a full-time student for 7 months of the year.
Okay, but how would that work for both? So say they were a full-time student for 7 months, but plus they had another $8,000 in income from a part-time.
Then we'd be able to use the full 6,000.
Okay.
So if one of the taxpayers didn't work at all, then they couldn't take the credit at all?
If they didn't work at all and they didn't go to school, full-time, they couldn't take it. You have to meet that criteria of being full-time student or have earned income.
But the other taxpayer could take the credit though, right?
No.
Nobody can.
Nobody can. And if they file separately, nobody gets it. Because when you're married filing separately, you're not eligible for it.
Unless they meet all 3 of the requirements?
Yeah, yeah. So you've lived apart from your spouse for the last 6 months of the year. You've been separated.
So deemed income doesn't change AGI for this calculation?
No. Yeah, so it's not like 3,500 and like 29,500.
So you would just go by the actual AGI for the percentage, even though you use the deemed income to get the amount?
Yes.
Okay.
Yes. Yep. Good questions, by the way.
I heard it's been cheap.
It's kind of a stingy credit. During COVID, they increased the percentages, and they increased the income amounts. But, they took that away from us, so. The IRS Congress taketh away. Well, actually, it's probably the other way around, but, let's see here. Let's do a couple more examples. Chang has AGI of $18,744 from employment. He spent $1,240 on qualified expenses for his child during the year. In this case, so his AGI is $18,744. We look at the chart. He gets, 33%? The $1,240 times 33%, that's the amount of his credit, $409. If his AGI were 15,200, his credit would be higher, not much higher, but $422. And if it were 25.5, his credit would be lower. Now we got Rachel as a single mother. She maintains a household for her 4-year-old son, Eric, AGI of 34,500. She had $3,800 in childcare expenses. So, maximum amount, again, we can't use the whole 3,800, we can only use 3,000. 3,000 is the max that we can use for calculation of the credit. We take that 3,000 and apply it to, we take that, find her percentage, what did we say, 34, is that a 25%? Oops. I might have had the wrong line, no, 25%. So 3,000 times 25%, so she gets a $750 credit. Okay. Not a lot, better than a kick in the pants, but.
It's a kick in the pants.
All right, so again, I said they provide this because they want people to work, people work, they make taxable income, they pay tax. I figure it's worth the investment and they'll get more taxes in the long run. The form that is used with child dependent care expenses is called the 2441. You can see here, the first part of this is who provided the service? Who provided the child care or the daycare service? Their name, their address, their identifying number, which is their social security number, or their EIN if they have an EIN instead. Was the care provider your household employee? So if they were so think about like nannies during the summer. Like if you've got somebody who comes and they only work for you during the summer, did they provide that, was it a nanny? Was it they would be considered a household employee. They asked this because if it was a household employee that earned over a certain amount of money, depending upon their age, I think it's like $2,000, $1,000 or $2,000, I can't remember. Well, I'll refresh my memory in the next chapter because we do payroll taxes. Then the employer or the household would have to file a W-2 for them and would have to pay payroll taxes on their behalf. So that's what that question is asking. And then the amount paid. Now this would be the total. If you have multiple kids and you just paid one provider, the total amount for all the children would be listed here. Not the $3,000 per child or $6,000, the total amount. If you pay $20,000, you put $20,000 there because the limitation is calculated down below. And they ask here, did you receive dependent care benefits? So if you did, then you have to complete part 3, which reduces the amount of eligible expenses. All right, can reduce the amount of eligible expenses. Now if you paid $20,000 and you got 2 kids and you had $2,500 of eligible expenses, then that's going to reduce your total amount that you can use to calculate the credit by $2,500, even though you paid that $20,000. So you got the provider up here, and then the children down here. Who was provided the care? Name, social security number. Were they over age 12 and disabled? So this is if they were, if they don't qualify as a qualifying child, right? And again, that cutoff is 13. The expenses that you incurred for that particular person. So if you've got 3 kids and you paid, I'll use 18,000, that's easier, $18,000 for 3 kids, you'd have 18,000 at the top, and then you'd divide up for each of those kids how much was paid for each of them here. Now again, you put the total amount there because the limitation is then going to be calculated down here. So add the amounts in column D. Don't enter more than $3,000 if you had 1 qualifying person, or $6,000 if you had 2 or more. So line 3 is never going to be more than $6,000. Okay. Enter your earned income. How much did you earn through wages? If married, filing jointly, enter your spouse's earned income. If you were a student or were disabled, see the instructions, that's where they give you, the disabled part as well, like if they're unable to work, that's different, because the expectation is that they're not then able to take care of the child, you still have to find care for them. Enter the smallest of line 3, 4, or 5. So 6,000 or 3,000 if it's one child. Taxpayers' earned income, spouse's earned income, the smallest of those 3. Let's see. Line 11, so this is gonna be your AGI on line 11 here. And then you take that number and apply it to the chart. Here, that's that table that we just looked at. Based on the, and enter the percentage here, multiply line 6 by line 8, whatever that decimal point is, and there's your expenses. So they don't have part 3 here, but part 3 again on this would be on the back page, is if you received dependent care assistance, or if you had dependent care, what do I wanna call them? Like one of those flex accounts where you have income taken out to put aside for dependent care expenses. Questions?